Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
G'day, welcome to the Australian Property Podcast. This is our weekly 2 cent segment. I'm Pete Wargent from Alan Wargent Property Buyers. I'm here with Chris Bates. Chris, how's things?
Mate, I'm doing well. Probably not as good as you with having a week in Greece, but you can see a little bit of a tan going on there, which is a good effort for you. How was it?
It was very, very hot. I suppose that's a bit self-explanatory, being the middle of the European summer, but it was actually a bit of a struggle for the kids during the day. You can see why those countries go in for the siesta type of approach, because, it was pushing 40 degrees in the middle of the day. But, pretty good. Managed to see a bit of history among the water parks and everything else. Went to the Colossus of Rhodes site. Pretty interesting stuff. Incredible history, really. It's kind of mind-bending. You can't really get your head around it when you're there. It's only when you sort of look back on the pictures. And I've just been at Trent Bridge today, so just enjoying a bit of cricket and dodging in and out of the various protests around England at the moment. So, there's never a dull moment. How's things your end?
Oh, mate, pretty in the groove right now. It's went for a couple of hikes with my son on the weekend, which was pretty cool because he's only 2.5 and he got a couple of Ks in one of them, so I was pretty proud of him. But not much is happening here, mate. It's we're going to New Zealand in a few months, so we're looking forward to that down in Queenstown, leaving the kids for a few nights for the first time. So that's going to be that's our 5-year wedding anniversary. So already looking forward to a holiday. But it's coming up to the spring selling season. I did a post about this yesterday on LinkedIn around the interest rates, which we're going to talk about. But I don't know. Everyone gets very optimistic at this point of time in the market. You've got obviously people in the market want to see prices growth. They want to see a really strong selling season. People looking to enter the market want to see lots of supply. And agents, and everyone's very optimistic about what's to come. My gut is, though, everyone's going to be disappointed again. I think that listings are going to be extremely tight, and everyone's going to sit on their hands. But let's see how we go over the next few months. What's your take, Pete, on where we are in the year?
Yeah, I was just, as you said, though, I just thought I'd take a look at what the listings numbers are, and gosh, they haven't really improved much at all, are they? 230,000 listings nationally as at 31 July. I mean, that's pretty low. It's only sort of 4 or 5 years ago, we were around 350,000. So, I mean, it's, as you said, that's generally the time of year when listings do start to pick up as you go into spring. But, I mean, I think overall people have been a little bit more cautious, I suppose, in recent months. Maybe, I don't know, maybe it's just sort of fear of job security and the economy slowing down and things like that. Maybe just because prices have had a bit of a run in some parts of the country. It'd be interesting to see. I think it's been a massive week in financial markets. So we'll cover a lot of that today because, that will obviously shape the outlook going forward as people start to get a better handle on what's going to happen with inflation and interest rates and all of that stuff.
Yeah, and I think it's just if someone's listening to this and they're thinking, I'm going to enter the market over the next month or so, even if we do see, you click on your domain, your real estate, and bang, there's 15 new properties. And that's been a lot more than what you've seen for the last 2 or 3 months. Don't just assume that that'll continue. I think this has happened time and time again over the last few years where there's a lot of front running of listings. The numbers look more positive and the media get behind it, that there's all these listings coming, and then they really die off at the tail end of each, the autumn campaign or the spring campaign. So let's just watch this. I don't really like to make forecasts, but I do think we're going to be a little bit surprised with the lack of listings. What's the big 3 stories, Pete? Because like you said, it has been a big week, and I wouldn't say it's everything's locked in yet, but it has been a bit of a shift in the story.
Yeah, so we're a little bit behind on this actually, but we'll take a look at the inflation figures, which, gosh, I don't remember an economic release that was as keenly anticipated as that one for quite a long time actually, because it was a potential inflection point for interest rates, whether it be up or down. So Yeah, and funnily enough, I was actually on holiday that day, so I only woke up in the morning and I looked at. I've got a kind of a dashboard on my phone. I could see the bond yields had absolutely tanked, so I knew straight away that the markets were breathing a big sigh of relief. And so there was the inflation figures. Then also we're going to look at what markets are pricing for the outlook. Reserve Bank did a media conference as well. And then also we'll look at what's happening in the market right now. We had the latest lending figures. Investor borrowing was actually at a 2-year high, about $11 billion for the last month. So some landlords are looking to get back into the market. So, but I think, my general feeling overall, Chris, and I guess we're usually in tune, is that, I think people don't need to probably get too excited on the upside or the downside. I think usually things aren't as good or as bad as they seem, and things are usually somewhere in the middle.
Yeah, absolutely. So we crack on with these 3 stories, Pete?
Yeah, let's do it. So the first one, let's look at the inflation figures. So basically, inflation came in at 1% for the June quarter and 3.8% for the year. So that's still above the target. But the Reserve Bank has been quite clear, actually, that the figure they're particularly interested in is the core inflation figure. For a number of reasons. I mean, it strips out some of the volatility, but also now, I guess looking forward, the government is kind of hacking the inflation numbers a bit with things like energy subsidies and other subsidies. That sort of trimmed mean figure, it gives you a kind of a sort of truer sense of the pulse of inflation, I suppose, and captures some of the breadth of it as well. Anyway, the trimmed mean inflation figure came in at 0.8%. So that was lower than expected. I think it's interesting when you drill into it. It was actually 0.84. And it's funny how the fine margins, just an extra tick there and you're into 0.85, which gets rounded up to 0.9 and da-da-da. But you could straight away see, you could almost feel that collective sigh of relief. The Australia's 3-year bond yield dropped immediately. It was like down 20 basis points. And market pricing removed any further rate hikes out of the cycle. And probably over the next 18 months, about 3 cuts priced in. So it was a total shift in the whole curve. I think, there's still some inflation around though. Rents were up 2% in the quarter. New housing costs were up 1.1%. Insurance. So even though markets were obviously relieved that we didn't get a higher than expected result, and it certainly takes the pressure off the Reserve Bank from having to do any more tightening, but we're not quite out of the woods yet. Inflation is still like 1% for the quarter. But I think, we'll have to see. I mean, it could easily be that the September quarter inflation is lower again, because generally inflation lags the economic cycle. And I do think as well that rents and construction costs are not going to have the same intense pulse, I suppose. So they won't have the same contribution going forward. So you never really know, as you said, Chris, you don't want to forecast this stuff because something will come from left field, like a global conflict or something. But it does seem that for now anyway, that disinflation trend is still intact.
Yeah, and I do think it's interesting to get a global perspective at times like this. I was on Martin North's podcast last week and we were talking about the UK in a lot of detail, and I was doing a bit of research on mortgage rates there and the inflation, and obviously you're there at the moment, so you'll get a really good pulse on, have the UK economy, and similar to the US economy, have they gone, have we over tightened? Have we really put ourselves into recession territories? Inflation really back in the bottle, and do we need to cut rates aggressively? You could already see their mortgage rates are actually, even though their cash rate's higher, their mortgage rates are lower than here. We haven't seen bank rates start to drop, but I wouldn't be surprised if in the next few weeks we start to see some good 3-year, maybe 2-3-year fixed rates start to come on the market, and banks start to use that as a way to get a bit of market share. And maybe it's, maybe mid-5s or, around the 5% that they start to really cut the 3-year fixed rate. So that'll be interesting, because that's a lot of buyers will say, okay, what's rates today? But where are rates going? That's what people are more affected by. And if they believe now that rate cuts are imminent and they're going to be reasonable in size, that's going to give them more confidence to sort of invest now and upgrade, etc. And so, and that's usually at a time when sellers are the most fearful. So it's that irony of very low listings at this point in the cycle. And you might look on national numbers and go, well, there's still a lot of listings around. But when you break it up from suburb, houses and apartments, and then good houses versus poorer houses, and you'll start to see that it's not really many good options out there to get quality assets. And I think that story is going to, potentially, when it does flip, sentiment will flip. It'll be all over the media. We know all the conflicted interests in the media market towards the property market, and they'll really get behind where the rates are going. So, yeah, it's an interesting point. What's your take on the UK, Pete, and the US as well, just while you're there?
Well, yes. So I'm in England at the moment. I suppose you could argue that what was it, the parable of the broken windows? They smash up enough buildings, then there'll be a lot of repairs to be done on the capital to be spent on repairing the damages and the maintenance. But God, it's been a real shit show, to be honest. This is not something I can ever remember. Thinking about going into a city and having to check the news to see which cities are having riots. We've had weeks of it now. It's just been, So I guess, obviously a change of government. There's a lot of tensions around at the moment for various reasons. But yeah, I think if you look, inflation's back at 2%. There's still some services price inflation around, but interest rates have already been cut. They're going to keep being cut, I guess, over the sort of probably the next 18 months ahead. There's a lot of angst around in Europe, I suppose. That's really noticeable. I think Australia, for various reasons, is pretty lucky, I guess, in terms of the demographic makeup and the way that immigration programs have run relatively more smoothly. Europe's got some real challenges in that regard. But certainly, the inflation story having seen inflation go to 11% on the headline figure back down to 2%. So at least now mortgage rates are starting to come back down. As you said, slightly different mortgage market in the UK, and people are starting to see that straight away. I think for the US, the narrative has changed very quickly. Markets are pricing for 50 basis points of cuts at least in September, and more by the end of the year. So we've flipped from needing to have a sort of a tight monetary policy in the US, with inflation now effectively defeated, really, with the exception of shelter. We could easily see, well, if you look at market pricing, 3% funds rate by the end of 2025. That's a very significant chunk of easing to come. There's a few jitters about a potential US recession with the unemployment rate now heading up. And Australia is not immune to that either. So, interesting stuff going on. I'm looking forward to being back in Queensland for the election soon as well. So, there's a bit going on around the world.
Yeah, let's crack into story number 2, Pete, around this swing in interest rates.
Yeah, so I guess there's some very interesting analysis. Gareth Aird from CBA in particular has done some sort of good analysis on what's happening. And it's worth remembering, actually, that there's other measures of inflation gauges. And the Melbourne Institute had its figures out, and the headline inflation rate was 2.8%. Down from 3.2% in June. So, that's the lowest since 2021. And in fact, if you take that at face value, that's inflation back to target on that gauge. Westpac are expecting inflation in the September quarter to be flat. And there's maybe a difference between core inflation, but you can see how if we get a soft inflation figure for the September quarter, that gets reported towards the end of October. Well, from November onwards, we could be on a similar trajectory to the US. But look, a bit can change between now and then. Anyway, Gareth Aird at CBA just did a really good note, just explaining, showing really graphically the change. We'll put the link in the show notes. The change in the cash rate pricing from 3 months ago, when markets were expecting 18 months from now, almost no easing at all, 4.1% cash rate. Now we're down at sort of 3.5% expected. So that's effectively 3 cuts priced in. And, there's a number of different reasons for that. It's been a lumpy journey down for inflation, but I think, as Gareth points out in the note, GDP in Australia, i.e. growth in the economy per person, has really been negative now for over a year, 15 months, and we'll probably get another negative quarter coming up. So that'll be 18 months of negative per capita growth. So if you think that inflation usually follows the economic cycle, it lags the cycle, well, that suggests that probably tight monetary policy is generally working. I think one final point, the Reserve Bank did a media conference after their policy announcement. They were quite clear that there's no cuts on the table, no cuts expected this year. But one of the things that sort of picked up from the statement of monetary policy was a little note on home building is expected to slow further. So I think previously it had been expected that home building would be solid this year, but it looks like it'll be lower still in 2024 with a very slight uptick in 2025. So it's really another 18 months of very poor home building activity. So the housing shortage is going to get worse if you take that at face value.
We're seeing very, very little demand for big renovations from our clients. I mean, we do very little in the house and land and the new apartment market, but you only have to look at some CoreLogic numbers to show that we're the doldrums in the apartment market and the new estate market. It's just certain parts of the country where they can sell. I mean, I just read an article this week on the AFR around them reducing the costs of rebates on lots, unsold lots down there. Larry Singer at the AFR reported, and so I do think that we're not really seeing that. That confidence around doing builds right now is very, very low. But when you do drive around, you still see a lot getting built, right? But it's usually the premium, higher end part of the market where a lot of the buyers they're targeting are cashed up, whether they're right sizing from a house to an apartment, whether they're downsizing, whether they're cashed up investors, let's say, or looking for a city boat hole when they've got a regional place. I don't think it's the typical market that they're built for, which is sort of the family market or the investor market. And so, it's not looking good. And that's probably a good thing for our inflation, right? Because if we still saw, a contraction of our supply of labor, building companies going under, competing for their resources with government spending and, industrial and all the other things that are using that we're building out there, you would see that we'd probably still see some inflation in materials and inflation in labor costs, and then that would get factored into our inflation numbers, right? And I think you're right around the rents. When you look at the rent numbers, the rental price growth really been slowing down, and to a point now where it's even though we've got ridiculously low vacancy rates, renters just can't afford more money, right? And so I think that's another good sign for the inflation story to be ending. I
think the market just adjusts, doesn't it? You read sort of anecdotal stories of multiple people sharing units or sharing rooms, or I think there comes a point where people just are not prepared to pay the asking rent, and then the market corrects that way. And the middle of the year is probably the time when that would happen as well. Fewer temporary visas on issue in the middle of the year. Not as many holiday makers and students and people on working holiday visas and things like that. So it might come back later in the year, but for now anyway, it seems that asking rents have rolled over actually in the big cities. So and it seems just generally, I think there's a lot of talk about the housing market recovery, but CoreLogic put its numbers out. There was quarterly price declines in Hobart, in Melbourne, in Darwin. So sentiment is not strong everywhere, and quite a bit of caution around, even in some of the cities with higher price growth. I think Brisbane, we've seen people just a bit more cautious. And just drilling into some of CoreLogic's figures, it did suggest that the price growth is really coming from the lower price quartile, about 3% growth over the quarter, but it's been much slower at the top end. I think it's probably borrowing capacities being contained that are just pushing people into some of those lower price points, and actually faster price growth for units over houses as well, which is I guess another function of affordability, I suppose.
I think it's a really big point at the moment, Pete, is everyone's budgets are massively compressed. Not because they don't want to spend more money. It's just that they can't. Everyone's asking what's their max borrowing capacity and going, oh, I wish that was a bit higher, right? Because borrowing capacity's fallen 30+%. Prices are actually higher. So that, what you could have bought 2-3 years ago versus what you can buy today just isn't matched, right? And so you have to make some compromises. You either have, or you have to find some money from family. And so absolutely that's happening for the fortunate ones, but the unfortunate ones, and even the ones who, can borrow money from their family, there's an interesting thing. Like if you put yourself in the parents and the grandparents' mind, right? So let's say they can borrow $1 million and they want to enter into the housing market, it's 1.2, 1.3 to get, an okay house in that area, let's call it. So parents might say, okay, we can bridge that gap if they can. But if you said to mum, dad, gran and pop, actually, I want to buy the best street and I actually want to buy the best house in the suburb and it's 1.6, are they going to give you 600 grand? No, right? So I think that's what the issue we're seeing is that absolutely their affordability is getting pushed down because of borrowing capacity, and parents will help, but they'll only help you get into the market. They're not going to help you go and buy the absolute top of the market. And so I think that's happening a lot at the moment. Yes, they're making transactions, and just natural human behavior is they go for a better suburb versus a better property in a cheaper suburb. That's just naturally what we do is we'll buy at the bottom end and we'll renovate it one day, or we buy a postcode rather than a property sometimes. And that would be my take. But I think over the longer term, that doesn't usually be the case. Usually the medium and the top end, because they're more scarce, because they're more desirable to higher income and the wealth, and they turn over less within a suburb, you usually see better price growth over the longer term in the top end of each suburb in the market. But at the moment, that's counter-cyclical. You're seeing it at the bottom end. And so when there's a time when money's flying around again, whether that's with higher borrowing capacities and lower rates and a lot of FOMO in the market and everyone's leveraging back up, you will naturally see that flip. And so it's a time now, I believe, where if you can enter that top 25% of a suburb, because you've got just really strong borrowing capacity. We've got a client who's just bought in the last couple of weeks. A few clients right now that are doing this strategy, to be honest. And what they're getting today versus what they're getting a couple of years ago at that top end is much better value for money. And it's not a big jump from what they currently own within these suburbs. It feels, it might on paper look like a big amount of money, but when you're comparing this property versus that property and what you get for the purchase price, you think it's a good deal right now. So I think that's a good option for people who are very cashed up at the moment.
You're right. It's generally a more volatile journey at the top end of the market, isn't it? Yeah. It's a thinner market. It's more illiquid. There's fewer people who can afford that part of the market. But when it booms, it really goes off. And then there'll be periods where there's not so many buyers around. But you're right, over the long run, even though the volatility might be the price of entry, but the long run results are very often good because of the sheer desirability, I suppose, of that top end. So let's wrap it up with this third story then, Chris. Investor borrowing to a 2-year high. So Australia's lending indicators figures showed new home loans up solidly 1.3% in June, largely due to an increase in activity from investors. And the average loan size for owner-occupiers, it's a new high of 636,000. So I saw this sort of led to a few things, like Comsec said it's a mortgage binge, and other people were saying, what are APRA doing? But I think the thing is, you've got to look at what's the driver of this. And I think we were actually chatting before we started recording. I think the average loan size for owner-occupiers is higher, partly because lower income earners are either locked out completely from buying their own home because of the lending assessment buffer, or they're just going in as investors and being picked up that way. So that it naturally drives the average mortgage higher. I think when you look at APRA's actual data for ADIs, there's very little high debt to income lending now. There's very little high LVR lending, and there's basically no low doc lending. So I think really a part of the higher average is just a function of lower income earners either being locked out or buying investment properties. I think just one other little wrinkle there. It was interesting to note that the increase has been driven in recent months by New South Wales. So more investors are coming back into the Sydney market Not sure particularly what was driving it, but I was interested to know this week that New South Wales Premier Minns has basically demanded that government workers are back in the office from Monday, and he's just called an end to the working from home trend. Now, I don't know, you'll know more about this than me, Chris, being New South Wales based. I don't know how successful he'll be, but that's quite a change. And I was wondering whether that could pull some demand away from some of those lifestyle and coastal market locations where people have been potentially working remotely.
Yeah, I mean, I've been watching these stories, and it's funny you brought this one up because it's on my little list here, actually. It is.
Yeah,
one
I
of
know
those
you love this story. It's one of your favourite little demographic trends, isn't it? How much are people in the office, and how much are they working from home? It's like one of your pet favourites.
It's a bit of an arm wrestle, though, isn't it? It's you've got the employers and where the economy going, and when there's a shortage of talent, unemployment rates low, the employers got the power. When maybe a recession's coming, maybe people are really worried about losing their job, and worker mobility starts to drop. Maybe and employers aren't as confident on the future. Then they want to get people back in the office to increase morale and make sure productivity stays high, and they can really see who's dragging the chain. And so I do think that. I also think there's a little bit of the worker wants to be back in the office. I think that, it's been fun, the work from home thing, but maybe they just want that little bit of a hybrid model. And I think some employers are going the whole hog and saying, no, it's actually really hard for us to do this hybrid thing. You got to come in all the time. But I do think it's going to go ebbs and flow. And so, yeah, at the moment, you would say that with the forecast over the next few years, and a lot of people are probably wanting to go back to the office to show their face, to show that they're doing well, and so they can protect themselves if there's redundancies or if there is ability to jump the ladder and get a pay rise, which is going to take off the pressure off their family. So I do think we're in that stage, but things change, right? And I think that, counter-cyclical, that's actually the time when you want to be going to these, an hour north of Sydney, an hour south of Sydney, vice versa in Brisbane and in Melbourne as well. Maybe now's the time when there's a little bit of uncertainty on where this work from home thing's going to go, because naturally when that pendulum flips back the other way, people get pushed out of the capital cities. A hybrid work gets more and more embedded in society. Then people will go, actually, yeah, I'm confident in my ability to get a job. And that's usually people on middle to higher incomes, generally speaking, are more confident. And so they will be willing to make those lifestyle shifts if they haven't locked in a long-term lifestyle option for their family. And so I think it's actually good buying now. You are finding a bit more stock in these areas. You are going to find there's less competition. And if you not worry too much on the short term, but you think actually longer term, this is a great asset, just be really careful where you buy, what you buy as always. And don't buy in some new house and land package estate. Buy something that is scarce, that's super desirable for someone escaping the city.
That's an interesting point, actually, for people to consider, because I think a lot of people talk about being counter-cyclical, but actually most people are pro-cyclical and they buy into the market that's booming. But I'm not really much of a religious person, admittedly, but I think it was a biblical phrase, wasn't it? That the last may be first and the first may be last. And that is generally held to be true. If you look at, if you bought when Hobart was the cheapest capital city, the market boomed, and then Adelaide was the cheapest capital city, and that boomed, and then Perth was the most out of favour place, and then that boomed. It does generally pay to be a counter-cyclical buyer, but it's easier to say, I think, than it is to do. So yes, even though it can feel counterintuitive to buy where there's not so many buyers. But anyway, just to wrap up on those lending figures, first home buyers 12% higher over the year, so that there is definitely some first home buyer activity happening. New home building loans are up 2.9%, which is the highest monthly total since November 2022. The Housing Industry Association, this is a quote from the Fin Review, said the residential construction had passed its trough. Refinancing was lower. I think as well, just one other thing, it looks like the peak of fixed rate loans rolling off is now past the peak. So I know there's still some people who are getting their fixed rate mortgages and they're going from 2% to 6% and having heart palpitations, but most of that has worked its way through. So there's still some monetary tightening in the system, but it's less now than it was, I guess.
Yeah, and I just literally found an article, people I'll send to you can put in the show notes around that lower quartile, median quartile, and then the middle quartile market, and then the upper quartile, and how the growth has changed over the last. It was actually an article that just came out this week from Domain. It's interesting to sort of back up our thoughts there. Look, my take on the investor market is absolutely you've got some people who, like even a client I was talking to, a couple of clients this week, to be honest, where they don't really want to do an upgrade right now because it's like, do I really want to go into more owner-occupied debt? But I'm in a really good position. I'm doing well at work. I've got a bunch of equity. I can easily afford a bit of a negative cash flow. I'm on top of my mortgage. Maybe we should buy some investment properties, right? And also, I do think what's motivating them to take action is they know that they've got to build wealth. That feeling that you're going to need to build wealth in the future is definitely getting more and more, I guess, embedded in people's psychology. And I think as you see generations shift, that sort of, I'll just be conservative, I'll get a house, I'll pay it off, I'll be fine, and I'll just put some money into my super. That's probably not how the younger generation are thinking. They think I've really got to do more just because they're either got to pay off their home loans, and B, they want to retire one day, and they can see that living costs are going to be really obviously getting more expensive over the years. So, these investors are probably they're probably upgraders. Both of them probably should be upgraders. One, I've stopped buying investment properties and encouraged them to do an upgrade, and the other one, look, they probably just don't want to do that. They probably just are going to stay where they are. They really considered the upgrade, but they decided not to have any more kids. And they said, let's just buy an investment property, right? And they just love their neighbors. And so they really thought through the upgrade. So they're investors that, are on the border. They're actually becoming investor market, but they technically are short-term investors because they obviously want to upgrade in the future. And they're going to, all of those ideas is I will get in the market now and we'll get out. And that's a really dangerous play to play into the property market, particularly when you've got a lot of quantity over quality buyers agents right now trying to buy in markets that have got momentum behind them. It's really hard, but Pete was talking about they're counter-cyclical. Usually these buyers agents aren't counter-cyclical. All they're doing is trying to jump on the wave when there's really strong fundamentals. And usually when you're doing that, you're jumping in late because you're not going to be the first one. And they usually use recent short-term returns to encourage you to get in. The problem is at some point markets top. And when markets top, they usually also correct. And you go from being in a position of power to a position of no power, more listings, prices are falling, and you kind of get stuck holding an asset that you never get rid of unless you just take it on the chin and go, I could have sold it for 600 last year, but I took 500 because markets were correcting. So be really careful with that right now. I do think the investor markets are pumped up because they're actually first-time buyers, but they're going through as investor lending. And people are having to do that to increase their borrowing capacity. So they're keeping their rents low. They're moving back in at home. They can go, I can borrow 800 as an investment or 600 as a home. I'll buy it as an investment. I might move into it. I might not. I might just rent it for a year. And so that's skewing the numbers right now because it's just buyers are playing with the way that they're structuring loans to get different borrowing capacities, would be my take.
Yeah, it does make sense. I think, just to wrap it up, I think the general theme here is that people get way too excited on the upside and the downside. And as I said right back at the beginning, things are rarely as good or as bad as they seem. But I guess looking at market pricing, this is what markets are pricing for January 2026, as I record this today with Chris, 3.45% cash rate. So that's quite significantly lower than 4.35 today. It doesn't mean it'll be exactly right, but for all of the sort of holler in the media about this and that, that's where markets are expecting to go. And you'll probably see the US leading the way with some significant cuts over the next few months. And it just changes the whole narrative. And I think you can get way too caught up in the latest excitement, but properties is a relatively slower moving asset class. And you want to be making sort of 5 and 10 year decisions and not getting too stressed about the next week or the next month. So those are the three main stories this week. Inflation figures were a little bit lower than feared. Markets swinging towards a rate cut potentially by the end of the year and maybe 3 or so by the end of next year. And investor borrowing coming back up to a 2-year high. But as Chris said, it might not be exactly as it seems with some of the first home buyer numbers sort of muddying the waters there. If you haven't joined already, do join us on the Rask community forum. Drop your questions in there. We can always do those in Q&A episodes. That's community.rask.com.au. And it's not just property. There's forum topics there for everybody. So, Chris, anything else to wrap up with this week?
No, I think that's it. I think it's been a lot. Don't jump at the shadows just yet. But when you do look at market pricing, I'm not someone who goes and looks at the ups and downs in markets, and there's like an analytical, I forget the term for it, when you look at investment markets and you try to find trends and when they break certain points and
technicals.
Technicals, yeah. And I have learned about that stuff a lot in the past, and it does look like you've broken a little bit of a floor. There was a natural floor that, when you look at yields, etc., and you think, oh, hang on a sec, this bit of data's broken that floor. And usually when that happens, that's the sign that things have changed a little bit, and maybe they're going to jump back up yields again, and some worse news will come about inflation. But you could easily see that that's actually then becomes a bit of a change in direction in the markets. And I do wonder though, just because how fast rates went up, do we oversteer to understeer, which is then oversteering us again, and we have to rate cut much faster than we thought, because it's like, oh, hang on, we've actually really tightened up our economy too much, and maybe people can't afford to hold on to their mortgages too much, and retail spending gets worse, and they go, actually, no, we need to save the economy with multiple interest rate cuts, which I think they're going to be looking at in the US. So watch this space, Pete. It's going to be interesting few months ahead.
It's an interesting point you made there. Yeah, I'm not big on technical analysis either, but I was just looking at the graph of Australia's 3-year bond yield. That's a key funding benchmark, right, for the Australian property market and for banks. And meandering along between sort of 3.5% and 4.5%, and then suddenly bang, like down to 3.4%, and that is completely blown through. Now we have seen a recovery, an increase in yields over the past couple of days since the inflation figures, but it's a complete narrative shift from where things were. Even if you went back to the start of July, we had yields were way higher, like at 4.25 or thereabouts. So, it's definitely a change, and long may that continue, because there's been quite a lot of households stressed out there, and some signs of mortgage arrears in some households and so on. So, plenty to keep everybody interested. So, have a terrific weekend, everyone, and look forward to catching up next week.
Sounds great. Thanks, Pete. Thanks for listening, everyone. Happy Sunday.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.